All right, today we are digging into a fascinating, kind of weird puzzle from Wall Street. NVIDIA, one of the most important companies on the planet right now, just posted these absolutely mind-blowing earnings. And the market, it pretty much just shrugged. Let's figure out what on earth is going on. So first, the headline number. NVIDIA just dropped its latest quarterly revenue, and it is a monster. $68.1 billion. If you needed a signal that the AI boom is still firing on all cylinders, well, this is it. And look at this. They didn't just meet expectations. They absolutely shattered them. Analysts were already predicting a huge number, right? But NVIDIA just blew right past that by over $2 billion, all thanks to a completely record-breaking performance from their data center division. And this right here is our central mystery. With news this good, unbelievably good, why did the market basically just yawn? The stock barely moved a muscle after hours. On the surface, it makes absolutely no sense. So, let's dive in.
Okay, so how do we solve this thing? Well, the first piece of the puzzle is you gotta understand what the market was really thinking before those numbers ever saw the light of day. It's all about expectations.
You see, the stock's quiet reaction wasn't really about the report itself. It was about all these other forces already at play. The stock was priced for perfection, as they say. People were watching this unofficial whisper number. You had traders taking profits in a classic sell-the-news event. And honestly, the market's just getting used to this crazy growth. It's becoming the new normal.
And that brings us to the most important piece of this puzzle, the whisper number. So while the official number to beat was $65.6 billion, the big money traders, the pros, they were all privately expecting something way, way higher. In a weird way, NVIDIA was a victim of its own success. Everyone already assumed they were going to crush it, so when they did crush it, it wasn't enough to really move the needle.
But you know what? The stock price is only half the story. To see where the real drama was happening, we have to look away from the stock charts and peer into a completely different arena, the high-stakes casino of options trading.
Just get a load of this number, 1.48 million. That is how many options contracts were traded just for the week of NVIDIA's earnings. This wasn't just casual investing. No, this was massive, active betting on a biblical scale, with billions wagered that the stock was about to make a huge move.
And the feeling in the room was overwhelmingly bullish. Look at this. The vast majority of those bets, nearly 2/3 of them, were calls. And for those who don't know, that's just trader talk for a bet that the price is going to go up. People weren't just optimistic. They were expecting absolute fireworks.
Now, to understand why so many of those bets went so wrong, we need to wrap our heads around one really key concept, implied volatility, or just IV. The easiest way to think of it is as an uncertainty tax. Right before a huge unknown event like an earnings report, uncertainty is through the roof, and that uncertainty gets priced into the options, making them super expensive. It's kind of like buying a lottery ticket 5 minutes before they draw the numbers. The potential payoff is huge, so the ticket costs a lot more.
So this massive buildup of hype and incredibly high IV set the stage for what was a pretty brutal but totally predictable financial lesson for a whole lot of traders.
The absolute moment NVIDIA released its numbers, poof, all that uncertainty, gone. It just vanished. And with it, the implied volatility was instantly, violently crushed. It plummeted by more than half. That uncertainty tax that made all those options so expensive just evaporated into thin air.
And what that means is, because of the insane price they paid for those options, traders didn't just need the stock to go up a little bit. Oh no. They needed it to go up by a massive amount, more than $12 a share just to break even. A small pop wasn't going to cut it.
And here is where you can see the pain. Just look at that top row. Because the stock stayed pretty flat, the most popular bets, the calls hoping for that rocket ship to the moon, and even the puts hoping for a crash, they both became pretty much worthless. That is the IV crush in action, and it just wipes out value for everybody who bought a ticket.
So what's the big takeaway from all this chaos? Well, it really shines a bright light on the huge difference between making short-term gambles on exciting events and building a real long-term investment strategy.
This table just lays it out perfectly. It contrasts two totally different paths. On one side, you have the low probability punt, right, where time is your enemy, and that volatility crush is just devastating. But on the other side, you have a strategy where high volatility actually helps you. It pays you to take on that risk, and your absolute worst-case scenario is just buying a fantastic company at a discount.
So ultimately, this whole NVIDIA paradox leaves us with a really powerful question to ask ourselves about how we approach the market. Are we chasing the lottery ticket? Are we here for that short-term thrill of a big event? Or are we trying to build a strategy that's designed to win slowly and consistently over the long haul? The answer really says it all.